Hello, this is Victor Cuevas with Victor for Advice. Today I want to talk about gold. Aren't you tired of looking at all those gold commercials? Well, I'm going to discuss owning gold as opposed to owning whole life insurance. Which one is better? Well, you don't want to miss this because you're going to learn a few things. And you know what? We're just going to use our common sense. That's it. And you're going to know the truth. Okay, here we go. I'm looking at this website called the Investing Guide. But let's go to this one first. The Gold Alliance. And both of these things are going to talk up gold. And we're going to look at why you should acquire gold today. All these commercials are talking about buy gold today. You got to buy gold today. I've been hearing this for 15 years. Buy gold. Well, why do you want to buy gold? Well, it says here gold offers true diversification. Well, what does diversification mean? Well, you're having your money in many different places. So I guess they're saying here that gold is just another place where you can put your money. Well, we can tap into this thing, and it's by allocating your investments across various financial assets, you reduce the risk of facing your portfolio when some of the assets crash. So they say, look, throw gold in the mix. It should be one of the things you own. Okay. Well, the same thing with whole life. Gold protects against crisis. Is that really true? What do they mean? Gold protects against crisis. Well, it says investors call gold the crisis commodity because one of the metal's fundamental traits, it can hedge against economic uncertainty, financial crisis, political turmoil, and even military conflicts. Not true, folks. I'm going to prove it to you. Gold hedges against inflation. This is probably the most true statement here. And it is true that many times that gold can protect against inflation. Gold protects against government debt and deficits. Not really. Gold protects against stock market corrections and crashes. Definitely no. Again, I'm going to prove this to you. Central banks own gold. Well, you know what? The biggest banks in America and even smaller banks, they own tons of cash value life insurance. They own more life insurance than anybody else anywhere. In fact, some of the big banks like Bank of America and Wells Fargo actually own more cash value life insurance than they do real estate. We know how much banks love real estate. So you can look at any construction site and you'll see finance by, and banks love real estate, but they love life insurance, cash value life insurance, even more. So no advantage here for gold over cash value life insurance. Let's look at a couple of other places here. 11 reasons to invest in gold. Gold is money. Well, I know they like to say that, but folks, if you hold gold, physical gold, you can't spend it. You can't go to the store and trade in a gold eagle and say, I want to buy something here. They won't accept it. It's not legal tender. Gold has to be cashed in for fiat currency, paper money, in order to spend it. So that's not really accurate. They say going back 3,000 years, well, you can't spend gold. So I hate when they say gold is money because it's not really money. It's a commodity. It's a precious metal. It is not money you can spend. Gold is a tangible asset. Well, it's fine. You can touch it. So is real estate. So is art. I mean, there's a lot of things that are tangible assets. Now, you got to store gold. And sometimes they go into this, sometimes they don't. But if you store it at home, there's inherent risk there. Someone could break into your home and take your gold. Okay? it's better to store it off premises, but then there's a fee to pay that. So now you're paying a fee to hold your gold. So not so great there. Gold has no counterparty risk. Well, it says, what do they mean by that? If you hold gold bullion, no paper contract is needed to make it whole. This is important because gold will be the last man standing, listen to this folks, when bubbles pop and crisis hits. That's a powerful tool to have in your portfolio when things start to go wrong in your country or economy. This is a false statement. It's not a good counterparty risk. I'm going to prove it all to you. Gold can be private and confidential, yes, but one of the great features of life insurance is private. And I'm going to go over that in more detail here in a minute. Gold is liquid and portable. Well, yeah, if you have gold in your hand, you can walk around with it. Do you really want to be walking around with gold? It's liquid. It's like anything else. You've got to find a place. In other words, if you have some gold coins or bullion, you can go down to the local I Buy Gold place and they'll give you money for it. I don't know how much they want to keep of it, how good a deal. Maybe you can shop around, see who wants to fool with that. You know, or you've got to cash it in someplace for money. I mean, so the liquid and portable, not an advantage. Easy to store and comes with low maintenance and carrying costs. Again, you got to pay for storage. You can put it in a safe at home. Gold requires no specialized knowledge. Neither does cash value life insurance, not really. Gold can protect against nefarious politicians. This is gold hedges your stock market investment. Definitely a no on that one, folks. All right, so let's blow all this stuff right out of the water, folks. Gold protects against crisis. Let's look at this. I've got a chart here. Gold prices, 100-year historical chart. And I happen to be a person that loves history. So let's go over here to 1915. Well, what was happening in 1915? Well, it was the industrial age. I mean, we had just learned how to fly a powered flight with the Wright brothers. So we had bi-wing planes flying around. Ford was just getting into mass producing Fords and cars and all that kind of stuff. And so what happened in that same period there, we entered into the First World War, right? Well, would the First World War be a crisis? Would it be financial crisis, political turmoil, and even military conflicts? And it's gold supposed to protect against these things? What happened to gold? Dropped from $547 an ounce and to 1920 to $285 an ounce. We had a crisis, a world war. Did it protect? No, gold dropped like a rock. You would have lost your shirt. Okay, so it starts going back up. We have the roaring 20s hit. Stock market is going crazy. Gold is kind of going down while the stock market is going crazy. Starts going up a little bit. Then we hit 1929. We have the stock market crash. And then we enter what? Start to get into the Great Depression. Well, gold goes up. So you're saying, well, see, Victor, it's protecting against crisis. Well, it did for a while. But what happened in 1934, the Great Depression really starts kicking in. Banks are folding like crazy. Bread lines are forming. And the economy is really starting to plummet. So gold is kind of faltering. But then what happens in 1939, as you see here, July? What happens in the year of 1939? Hitler invades Poland. Next thing you know, We're in a world war, and look what happens to gold. Plummets like a rock. You get down to 1945 at the end of the war, gold went from 762 to 555. Did it protect against crisis, military conflicts? Not at all. But guess what? It gets even worse, because here we go into 1946, 47, we're going to 50. What is happening? Baby boomers are being born. The economy is going like crazy. Of course, we entered the Korean War. Gold spikes for a little bit, but then through the Korean War lasted 3 years, 1950 to 53, it starts going down. And it keeps going down. Well, we're in the 50s. The 50s was a wonderful time in American history. I mean, the families were going like crazy. Subdivisions were being built. It was a beautiful time. I was born in 1953. So here we go, keeps going down. Oh, 1962, 61. Well, what's happening during that time? 63. Did we have some political crisis in 1963? Yeah, John F. Kennedy was shot. Not too long after that, his brother Robert Kennedy was shot. We go into the 60s. What do we got in the 60s? We got civil rights. We got Martin Luther King. We got riots all over the country. I mean, it's a horrible time. We got the Vietnam War, 1966, 65. We're in the middle of the Vietnam War. We're getting campus riots all over the place. We got the hippie generation coming in. I mean, it seems like the world is going to hell in a handbasket, and where's gold going? Into the toilet. I'm not feeling this gold protects against crisis, folks. I'm not feeling it. So it bottoms out in 1970. Now let's look at how gold has performed historically. So we go back to 1915, and gold is $553 an ounce. Now, 1915, now we're at 1971. That's a lifetime, folks, and gold is at $279 an ounce. How do you like that? Buy gold. It's great for a crisis. It's a great hedge. Diversify with gold. Lose your shirt with gold. Now, if you had had a life insurance policy, it would have been going up every single year like clockwork. Been way up here, and here's your gold down here. If you had all your money in a life insurance policy during all that time, you'd have been way better off than gold. But let's keep going. So now we enter in to the 70s, crazy time, and we're getting into inflation. Some other way. Look, I remember here in '73 when gas went from $32 a gallon to 32 cents a gallon to 75 cents a gallon in a year. Yeah, we had inflation going on here, folks. And it did work for inflation protection, but boom, right here in 1974, another rock. Economy stabilized, it went back down again. But what happened in 1976, folks? Jimmy Carter became president. My personal opinion, the most disastrous president that ever served in American history. Inflation went crazy. I mean, if you wanted to buy a house back in those days, try 10%, 15% mortgage. I was in the Army during that time with a wife and 2 kids, and it was a really rough time in America. Gold went up, gold went up, gold went up. And what happened in and we peak out right here at about, let's see here, $2,500 an ounce. January 1st, 1980. Look, is it way higher than 1915? Yeah, but nobody would have owned gold that long. So you're at $2,500 an ounce. What happened in January 1980, Ronald Reagan, the greatest president we ever had, was inaugurated as president, and the economy, boom, started to turn around almost on a dime. With good economic policy coming in, stock market started taking off, and what happened to gold? What happened to this great diversification? The stocks are going up, gold is going into the toilet. Go figure. So you go up and down, and it drops down, and here we are in 1985. Just 5 years later, folks, gold went from $2,500 an ounce to $823 an ounce. Do you really want to own gold? I mean, so you own gold, and the country goes into the crisis with wars and depressions and everything. Gold drops like a rock. The economy is booming in the 50s. Gold drops like a rock. You have an inflationary period at the beginning of the 70s. It goes up, good, drops down like a rock over a 2-year period. Then through 2-3 year period, then Carter becomes president. It goes up like a rock to all-time level 2,500, and just like that, in 5 years, it loses what, 200% of its value? It's crazy. I mean, we're talking about a roller coaster ride, bar none. Stocks don't even do that. Well, then it starts to go back up again. You're back at $1,000 an ounce over here, $1,600 an ounce. And what happens in 1987? Well, we did have a stock market crash for a while, but things corrected pretty quickly. And what is happening here as we enter into the 90s, folks? We have the technology boom. We really started in the 80s. Remember, Microsoft started around 78 to 80. And so we really went into the technology boom. I mean, the economy was on fire during the 1990s. Stock market was going. I mean, you could have put a blindfold over your eyes, thrown a dart at a board full of stocks, and any stock it would have hit would have made you money. It was a heyday of the stock market. What was gold doing? Dropping like a rock. So we get down to 2001. We had the technology bust, and we had a recession that started the 21st century, 2.5-year recession. So in 2001, gold is at 423 from where it was in 1980 at 2,500. So if we go back to history, you got to go back to 1972, year 2000. We got 30 years and gold hasn't gone anywhere. Went straight up and then went straight back down. So if you'd have been holding gold since the 70s, you'd be nowhere. And remember, folks, gold does not pay an interest, dividend, no passive income. It's either going to go up in value or down in value, and you hope and pray, keep your fingers crossed, that when you get ready one day to liquidate your gold, it's worth more than what you bought it. But as we can see throughout history, it's a crapshoot. All right? So then we start to come out of this recession, and gold starts to go very well, right? So we get all the way to 2011, 2012, and we're just getting back close. We're still not where it was in 1980 when Reagan was inaugurated as president, right? We're still below that. And here we are in 1980, and it's 2011, and we're just getting back there, and then it comes back down again. $2015 goes back up again and back down again. So where are we at right now? Well, gold is holding steady. It's not dropping. And some people say it's going to go up. Who knows? What I'm saying is this. Do you want to go buy gold and go through this right here? I don't get it, because when I go back to these things here, it's not a hedge. It can be a hedge against inflation. It doesn't protect against government and debt and deficits. It doesn't protect against stock market corrections, because we see when the stock market is on fire, gold goes in the toilet. I mean, you know, if the stock market does poorly, the stock market did poorly over here in the Great Depression, gold went down too. So I don't know why these guys even say these things, because it's not true. So you go over here to silver. Well, how about silver? Well, here's silver. Back in August of 2002, it was at $4.53 an ounce. It goes way up here to $46 an ounce. And then it drops like a rock. Goes up, down, up. Looks like the stock market chart. There's no stability in silver either. Right? Well, let's go to the stock market. We got the stock market going back all this time, and we got the ups and downs of the market. Right? So, this chart looks a whole lot less volatile than this chart. Heck, I'd just rather put my money in the stock market than put it in gold long term, because we see long term, you just don't know where you're going to be with gold. Got a little bit better chance from here. Now let's look at life insurance. Now this is the dividend rates for Massachusetts Life, one of the top guys. Massachusetts Life's been around since 1800s, along with Guardian. I use both of them, Guardian and Massachusetts Life. You got New York Life, you got Life of the Northwest. You got some other ones that have been around since 1800s. Folks, look, these insurance companies have paid interest and dividends every single year, never missed a year. Now, I can't say, neither can they say, that dividends are guaranteed, because they're not. But when you go back 120, 100, 120, 150 years, and they've always paid a dividend, pretty reliable. So we go back in 1978, and you had dividend rates of 7.4. By the time you get to 1985, you're in a 12% range. And then they drop, because it fluctuates on interest rates, because the insurance companies tend to put their money in safe things, and if the safe things don't pay much, then they're not going to be able to pay as strong a dividend. But you can see from 78 to 2016, you went from 740 all the way up into the 12% range, back down to the 7% range again. But this is compounding interest. So if you have your money in cash value life insurance, and interest and dividends are paid, and your cash value goes up, now you can't ever lose that. Those earnings are attributed to your cash value. They can't go back. So now you have more money in cash value earning interest and dividends. That's compounding interest. With gold in the stock market, you don't have that. It either goes up or it goes down. It goes up, it goes down, it goes up. It's never up every year, like whole life insurance. So if you would have, from the 78 to 2016, if you would have had your money in a cash value life insurance the whole time, and if you'd have started with 100,000, you'd be into the seven figures by now. Hell or high water, you'd have been there. Nothing would have hindered that growth, except the rise and fall of the dividend rate. It doesn't mean your cash value is rising and falling. It just means your cash value isn't growing as fast when it's at 7% dividend rate as it is when it's a 10% dividend rate. But it's still growing every year, guaranteed, no matter what. So if I want to hedge against inflation, and I know I have money that's going to go up every year no matter what, that's a pretty good hedge against inflation. Now, right now, inflation is at 8% rate, historical high record rate, and dividend rates are Mass Mutual's at 6%. No, it's not keeping up with inflation, but for a long time, inflation has been in the 2-3% range. So, pretty good hedge against inflation, hedge against wars and government downturns and Great Depressions, First World War, Second World, Great Depression, Korean War, Vietnam, racial unrest, makes no difference. We got stock market boom, we got stock market bust, makes no difference. Cash value life insurance and a whole life policy is going to grow every year, no matter what. Depend on it. Nothing is more safe. Not even putting your money in the bank. Nothing's going to be more safe for your cash than putting it in the cash value life insurance policy. Whole life. You can use index universal life. That's another story and a whole nother video. But cash value life insurance for hundreds of years has been the place that you can depend on that your money is going to be safe. So you want to diversify your assets instead of putting 30% of your money in bonds, which are very volatile and not dependable either. Put 30% of your money in cash value life insurance. You'll be much better off. Much better off long term. So let's look. So what have we established? We know that gold, all those reasons why people say buy gold in all these commercials, buy gold, buy gold. We see now from history that gold isn't that great of an investment. Sometimes when you buy gold coins as a collector's item, they can grow in value, but you want to base your retirement on that? You want to base your future 30 years down the road on that? No. Maybe someone can convince me after watching this video. By the way, if you like this video and like the content, please like it, subscribe to my channel, because I'll come out with some more videos and just using my common sense to show you. Okay, so now let's look at the benefits of owning whole life. Now, we looked at these articles about the benefits of gold. I'm going to show you the benefits of whole life insurance. It's liquid. They say gold is liquid. Oh, but you got liquidity in gold. Well, you still got to cash it in for fiat currency. So, lots of things are liquid. So you can access your money in cash value anytime you need it. You need your money in cash value, you can access it. You can take money out of it, or you can borrow from it. We suggest, borrowing from it, or you can cash in some of your paid up editions. It's just cash sitting there. So you have good liquidity. It's a safe. You bet. I've already went over that. You can't lose your money. Can't lose it. It is safe as safe can be. Private. No one knows you have it. Well, one of the things that people talk about gold, well, it's private. I mean, you can have it in your safe. No one knows you have it. Well, guess what? Life insurance is the same way. You could have $1 million sitting in the cash value life insurance. Nobody would know it. If they did an asset search, they wouldn't find it. Unless you tell somebody, no one's going to know it. And it's protected against creditors. Even creditors don't know you have it. You can borrow from it. You have a private family bank you can borrow from anytime you want for any reason without qualifying it. So let's suppose you've got $100,000 of cash value. You want to borrow $50,000. You call the insurance company and says, send me a check for $50,000. I want to borrow against my policy. All your cash value stays in the policy. It's not moved anywhere. It continues to earn interest and dividends. It is an asset paying. It's a paying asset. continue to grow, just borrow from it. You can pay back anytime you want on your terms, or you never have to pay it back. So, pretty good benefit. It's flexible. You can pay full premiums or not. You can pay when you want or not pay at all. So the way we design it, and we design it differently from State Farm guy or whoever down the street, if you want to put $10,000 a year into a cash value policy, we're going to have 10 to 20% of that going into the base and 80 to 90% going straight into cash. So if you can't pay the $10,000 that year, so well, I can only pay $5,000. Well, just only pay $5,000. It's no big deal. Pay $3,000. And then the next year you want to go back up to $10,000, fine. So it's very flexible on how you pay it. You can get to a point where you say, I don't want to pay into it anymore. What? Enough cash value to continue to pay the policy. Or you can just go reduce, paid up. Say, look, I'm never going to pay into it again. I want to preserve my cash value. I want it to grow. I just make it reduce, paid up, and the insurance company will say, okay, this amount of cash value pays this death benefit. You're done. No more costs coming out of your policy. Your policy now is a paid up asset, like having a paid up house that produces income, but it's better than a paid up house because houses have maintenance and taxes and insurance, whereas your life insurance has, when it's paid up, there's no cost coming out of it. It just produces cash for you every single year, year in, year out, guaranteed, no problem. Okay, it's an income producing, so it pays interest and dividends. I already showed you the Mass Mutual history of the dividends and how high they can go up and they can come down, but it pays an income. Gold doesn't pay you anything. Heck, you can buy a dividend paying stock that pays dividends. You can't even, gold doesn't pay you anything. Okay, so you have protects against crisis. Never lose value and always there when you need it. So you can hold on to it and you don't have to worry about it. If we have some horrible thing happens in the economy, we have another war, Putin going crazy out there, stock market's going down, your cash value is up. It's not going anywhere. You lose your job, you don't have to worry. Listen, you put a bunch of money in gold, down the road it's worth 50, 60, 80% less than what you paid for it. And now you lose a job, you have an emergency, you need some money. Now you're cashing out gold at way, way less than what it was. Never happened to you with life insurance. You can put that money in there every year, year in, year out, or put a big chunk in there and let it go. And 10, 20 years down the road, you have a big emergency. The cash is a whole lot more than what you put in. Tax benefits. No taxes paid on the growth. As long as you stay within IRS guidelines, you never have to pay a dime of tax on the growth of your money. And no taxes on borrowed money. So you can, when you borrow against it, you don't have to worry about it. You borrow against a 401k and then you lose your job, that money might end up being income to you. All right. So here we go. No. So we know the tax benefits are great, but here's the best part. It pays income tax-free for life. So you can put money in a whole life policy for the next 30 years. 15, 20, 30 years. You get into retirement and you want to supplement your income, that life insurance policy can pay you an income for life tax-free, not a dime of tax coming out of it. You can't do that with gold because anytime you liquidate gold for income, if there's a profit there, guess what? You got to pay a tax. Same thing with stocks. Not so with the cash value life insurance. Pays tax-free income for life. And here's another great part. When you die, you get to leave a death benefit. Because all life insurance, no matter how efficiently we design the policy, in order to stay within the IRS guidelines and to enjoy all those fantastic tax benefits, we have to have some form of death benefit attached to that policy, which will always be a lot more than the death benefit. Well, until you get to about 100 years old, and then the two meet up together, So all that money in the death benefit goes tax-free. So if you die and there's $300,000 in cash value, it may very well pay $1 million to your heirs tax-free. Tax-free. You can't do that with a stock account. You can have $1 million in a 401k and you die, leave it to your family, it all gets taxed. They're going to lose 40%. So if you want to save for retirement in a 401k or an IRA, you've got to remember, and you're getting that tax benefit up front, you got to remember one day that's going to be 100% taxable. And when you leave it to your heirs, they're going to get hit with the taxes. Uncle Sam is going to take a huge chunk of your money. But when you put money in a life insurance policy, you can draw income tax free and you can leave it to your heirs. Fantastic benefit. All these benefits apply to a certain extent to Index Universal Life. In fact, if you want to supercharge exponentially your tax-free income, may want to look at an Index Universal Life. Again, whether it's whole life or Index Universal Life, you have to be working with a professional like myself who knows how these things have to be structured and designed so that you can maximize the cash value accumulation, maximize the tax benefits, minimize to the lowest extent possible the cost within that policy, so that you can enjoy these tremendous benefits. And just so you'll know, as far as cost involved, I can show you in the numbers that having your money in a market with a financial advisor can cost you a lot more than having your money in a life insurance policy. So I hope this has been helpful. I know this has been a little bit long, but if you stuck with it, you've learned a lot and you've seen the truth. So again, if you like this video, you like the content, please like it, subscribe to my channel, because we've got a lot more of these things to go. This is Victor Cuevas, Victor for Advice. God bless.